Hello, everybody. A warm welcome to everybody on this panel discussion on India's future economic outlook in light of the approach of the US. This is something which is under a lot of discussion every day, day in, day out, in all the print media, in the soft media, everywhere. The words which we have used as a title of this panel discussion, where we have said approach towards India by the US. So it just not is all about the tariffs which have been inflicted upon India, but much more. The H1B visa issue, which has now been raised, and last but not the least, and very important, the kind of relationships which they have been, US has been building on with Pakistan. So these are all the issues which have got some kind of an impact on the Indian economy and the future Indian growth. In the panel today is myself, Dakshesh Kothari, and Rajit Kothari from Ashutosh Financial Services. And the resource person today is Mr. Atul Bhole. He is the senior fund manager of Kotak Mutual Fund and a veteran in the industry. So anybody who would be watching would feel that, oh, he's quite young. And why do I call him a veteran? But the fact is that he has got an experience of 18 years in asset management. At the same time, I can personally vouch the kind of the depth of knowledge and understanding which he has developed in his tenure would definitely allow me to say that he is really a veteran. And he is going to be our resource person today. I will hand over to Rajit to start with the first point of discussion. Please, Rajit.
Very warm welcome.
Thank you.
Starting with the global scenario, which is the hot topic of discussion today, wherever we go, whether it's the media or any kind of conversations that are happening around, with the US imposing more and more barriers in terms of the trade aspects with the tariffs, and with the sharp fall in the value of the rupee vis-a-vis the US dollar that we have seen in the recent past. What do you think should be the approach of any equity investor keeping these changes in mind?
Correct. First of all, thank you for this opportunity and thanks for the kind introduction. I think nobody is veteran in the market. Market keep teaching us every day. So coming to the topic, I think as shared in the introduction, so apart from the financial or economic aspect of it, somewhere there is a lot of geopolitics behind the economic policies which the Trump administration is sort of imposing on India. So geopolitics obviously may not be the issue of or topic of discussion here because it is, I think, beyond our comprehension. But when it comes to economic policies or financial policies, I think compared to the other nation, our neighbor nation, Pakistan, I think the economic ties of India with US are much bigger or vast in nature. And it is not only one way sort of thing. It is not that only India is exporting to US. US also is dependent on India in many ways. A lot of their companies are earning billions of dollars out of India, say Amazon, Microsoft, Google, etc. So I think behind all these things also, as you mentioned, there is every day it is a topic of discussion in media, TV and all. So obviously there are a lot of facts, but I think there is noise which is 10 or 20 times bigger than the actual facts. And somewhere I think because of the nature of the dependencies between both these countries, somewhere I think the solution should emerge over next maybe 2-3 months or so, because it is in nobody's interest to continue with this kind of standoff. Having said that, if you look at the data, US exports are just about 1.5% of India's GDP. Out of this 1.5%, even almost 40-50% of the goods are in the exempt list. So they are not at all liable for that 50% tariffs. So the question is now just 50.6 or 0.7% of GDP, which is exposed to US. Out of your total exports, 20% are to the US, and again 50% are exempt, so maybe 10% are getting impacted. So I think as a country, it is very, very manageable, I think. It is not going to impact our growth rate in a big way. And obviously, government and RBI has done so many things not to counter this kind of tariffs, but generally to sort of support the economy. I think this impact will not even be felt. The thing to worry about is basically employment, which is particularly from the two sectors, gems and jewelry and textile. So the impact in terms of money or amount will not be very big, but because of this tariff, if the exports get hit, these sectors might have to resort to employee entrenchment to contain cost, etc. And I guess that will be temporary in nature. So I think that is the only extent of impact we need to worry about, the unemployment which can happen in the textile or gems and jewelry sector. But apart from that, I think most of the things are very, very manageable. And the thing is, there is a tendency or recency bias in terms of what has happened in last 3-6 months, and we expect that the things will continue to worsen. But sometimes it makes sense to take a contra view that the good things doesn't last forever, even the bad thing won't last forever. So I think I firmly believe that somewhere the solution would emerge in next maybe 2-3 months.
Okay.
And on account of this, are we looking at some kind of contraction of Indian economy, or maybe slowing down of growth? Contraction is a little
Yeah.
tough word, but the growth rate, say according to certain estimates, people say that the growth rate of India might get scaled down by maybe 0.5% or 1%.
Correct.
So would it really impact if these kinds of impasse continue, then is it expected that it would impact the economy in general, and maybe some sectors which are indirectly impacted? Is it something which might be a scenario in times to come?
Yeah, so statistically looking, if things stands as it is, that thing can impact Indian growth rate by say 0.5 percentage point. So maybe rather than 6.5, the growth rate can come down to 6, etc. But as we discussed earlier, the economy is not it's a dynamic sort of or dynamically managed kind of situation. And because the government and RBI has done so much of things in last 6-8 months to support the consumption or consumption revival. So even if the economy to slow down because of the US export impasse of by say 50 basis point, probably the consumption revival can make most of it. So that's why we believe that the impact even may not be felt. It will be felt in pockets like we discussed, maybe textile or gems and jewelry, and to a remote extent, I think it is hurting the sentiments in the IT side to some extent, not impacting business as itself, but just hurting the sentiments. So that's where I think we stand, that there are a lot of counterbalancing measures which are already taken or started by the government, and it should help us negate that impact.
Okay.
Yeah. Moving further from this topic of the US and its impact, overall, how do you think are we placed at present, considering the valuations of the market, the earnings growth of the companies, and the overall sentiment at large?
Okay. So actually, sentiments many a times is the outcome of what has happened in the last 6 months or 1 year. And obviously, in last 1 year, we have not received any kind of return from the markets or equity markets. There's a flat performance. Various reasons for that. One, the starting point of valuations were high, and then we got 4-5 quarters of very muted earning growth from the corporate India. So that had resulted in this flattish performance. But to put it in the global context, if you look at the many of the global markets, they have done exceptionally well in last 1.5 year. When India has remained flat in terms of returns, Chinese market has given some 55% return. German DAX has given 30% return. Even other markets of Europe has done very well. S&P and Dow of US continues to go up, and they have also given 15-20% return. Other asset classes like gold and silver has returned some 55%. So our underperformance is very, very stark compared to most of the markets and asset classes. Because of this 1 year of time correction, the long term, the valuations like P ratio or price to book ratio or even earning yield to bond yield, those ratios have come to 10-year averages. So the valuation froth or overvaluation which was there 1 year back, I think to a large extent it is taken care of by this time correction which has happened in the market. So that is on valuation. Secondly, on the earning growth, there also we got the disappointment. 2-3 reasons mainly. Last calendar elections were there, and generally government machinery slows down. It impacted the churn or rotation of the money in the businesses, and at the same time, RBI adopted very strict stance in terms of keeping liquidity in deficit. So they were defending rupee that time, if you remember, and kept liquidity in deficit. And also there were strict warnings from time to time to banks and NBFCs to slow down the growth. And even some circulars also came to contain the growth, particularly on the retail and infra side. All these things impacted the profit growth coming down for the corporate India, and it from a 13-15% profit growth post-COVID, we came down to 6-7% profit growth in last 4 quarters. So that resulted in market giving flat returns. So I think even on the earning side, I think the worst is coming to an end. From the start of the year, I think cognizant of this slowdown, government as well as RBI has changed the stance almost 180 degrees. So the government capex has come back completely. Even April to till now, the lot of expenditure has been front loaded. RBI from a deficit liquidity of 2.5 lakh crore, the liquidity has come to 2 lakh crore positive now. Rate cut and CRR cut happened almost 100 basis point. And the latest we got a GST. So even before GST, sorry, we got a tax cut for common people to the extent of 1 lakh crore. And now we got the GST cut and substantial reduction. So I think with all these measures and good monsoon and all, and on favorable base of this 5-6% growth, I think from December quarter onwards, we should come into the double-digit earning growth territory, and the market should respond to those double-digit earning growth. So this is on the valuation and the earning growth. The third factor for market return is basically flows. So while domestic flows were very strong, the FIs are continuously selling. At the same time, promoters and the private equity or venture capitalists, they are also continuously selling. So the domestic investors are absorbing their selling pressure. Even there, I think the foreign flows to a large extent possibly are coming to an end. One, because the markets overseas have done very well, and we have sort of underperformed, particularly in dollar terms, we are down 8%. So it makes Indian market attractive for them. And by continuous selling, their ownership of Indian market has come down to 15.5% from the peak of 22.5%. So I guess obviously at a point they would also rethink about how much exposure they want to have in India, and possibly with the earning growth coming back, the FIS flows can also reverse. So from valuation point, earning point, as well as flow point, which are three very important factors for the market, I think we are somewhere close to the bottom, and hence the market, I believe, offers a lot of margin of safety.
And say, as you said, that the valuations are something which are right now pricing the kind of stagnation in earnings and those kinds of things. And hence the return on the Nifty, as we all know, is maybe in last 1 year is basically nil.
Yeah.
So now what could be the major triggers on the upside and on the downside for the Indian market? So last 1 year, yes, we know that there isn't anything which has happened much.
Right.
But on the upside and downside, what could be the major triggers?
Yeah. So I think the upside trigger obviously is the pickup of in the economy, particularly on the consumption side. So last 2-3 years, except for say top tier of India, maybe 5-10 crore people who were consuming, most of the Indians were not able to do that because of the purchasing power and inflation. I think the risk is now that despite government and RBI so many things, if the economy or the people doesn't respond in terms of pickup in consumption, I think that is a bigger risk for not only for the market, but as a country, it is a big risk. If despite doing rate cut, tax cut, CRR cut, GST cut, if the consumption doesn't revive, I think then we have to think very deep and really about what's happening in the economy. So that is one risk for the market. And as well as the trigger. If it responds, it is a big trigger. If it doesn't, then it's a problem. And the other trigger, which you may call as a wishful thinking on my behalf, is basically any kind of deal between India and US. I think that will take care of a lot of negative sentiments of fears which are there in the minds of people or even investors, foreign investors. I think some kind of deal, and deal means there will be a lot of give and takes. And sometimes India has to sort of agree on many things. But despite that, I think certainty will bring cheers to the market, even if we sort of be slightly on the receiving side. I think any kind of deal between US and India will be a positive trigger for the market.
We have got many investors outside of India, and if we compare the currency difference in the fluctuation in the last few quarters, then every currency by and large has appreciated against the rupee, whether it's the US dollars or whether it's GBP, Euro, STD. Then this has led to a lot of loss in the value of the investment of these investors. How should these investors approach the market and the currency fluctuation going forward? And what would be your word of advice to them?
Yeah, so you're right that if you look at particularly last 6 to 8 months, the currency, I mean the rupee depreciation versus most of the other currencies has been remarkable. But I think one has to compare with slightly longer term horizon. So if you look at 3 years or 5 years, actually Indian rupee performance versus many currencies has been very, very stable. I mean, I'm not even talking about Brazil or Turkey, etc., but even GBP and Euro, our performance versus them and USD, that peg, has been very resilient. Only in the last 6 months, I think we did sort of depreciate because of, I think, these concerns on tariffs and all those things. I think like in the past maybe 6 to 10 years, the kind of resilience Indian economy has achieved in terms of fiscal deficit and current account deficit, and that is providing a lot of stability on interest rate, inflation and currency. I think this broad macro setup should continue, and hence the depreciation which we used to see in the past, like every year maybe 4-5% depreciation, that may not happen going forward, because the basically currency depreciation is a inflation differential between the two countries, and I think we have got a very strong handle on inflation and interest rate, and hence the depreciation may not be very big. And if you look at the growth trajectory of India versus many other economies, we are growing by almost 4 percentage point higher by those developed economic like Europe and US. To that extent, our market has the capability to deliver better returns than those markets. So even if rupee is to depreciate by slightly 3% every year, I think the returns will make up for that currency loss. So I think one should not be very concerned about the currency factor while investing into India. The opportunity is big, and we are capturing this opportunity with prudence, and that is very important. Earlier, maybe sir will remember 15 years back, India was called one of the fragile five. I think we should call India now one of the solid five. We have got credit rating upgrade, and our bonds are getting included in the global indices. So there is remarkable improvement on the macro stability side. So I think currency depreciation, which is there maybe 15 years back, I think it is thing of the past now. And whatever currency depreciation going forward can happen, it will be because of the inflation differential. And there we also, I mean, we got a very strong sort of handle.
So just taking what Rajit said a little further. So the way the global investors, so basically the non-resident Indians who are working with us, the way they look at is that one is a tactical view, which is for the coming 1 year, right? Wherein whether to transfer the money today or after a little time for investment in India. They are all sold to the idea that yes, India is a country or an economy or a stock market where we should have an exposure. But then they are waiting for that tactical opportunity, whether we should transfer it today, tomorrow, or a little time, you know.
Okay.
So what could be, so as we all know, say US dollar vis-a-vis the US dollar, rupee has depreciated by around 6% in last 1 year, GBP around 8%, euro 12%. So is there a further depreciation which we are looking at in another 1 year, or rather what could be our 1 year bet on the exchange rate front, and what could be the 5 year bet? Say if we tell our investors that okay, this is a aberration which we are looking at as of now, but then over a period of 5 years we will once again return to that 2%, 3% CAGR kind of a scenario.
Yes.
So that can give them a comfort in short run and long term. So what could be your take on what could be the exchange rate scenario in 1 year and on a 5 year time frame?
I think on the exchange rate, going by the theory or the inflation rate differential, etc., I think lot of the depreciation has happened in last 6-8 months because more of the sentiments than the inflation, etc. So going forward, I think maybe next 6 months or 1 year, the depreciation will be very, very muted or limited. If you remember, rupee has remained in the band of 82 to 84 for long, and then suddenly it came to 88. So probably for some period it can take a pause here, maybe 88, 90, and then how things play out, I think we will see how it responds. But definitely in near to medium term, maybe 6 to 12 months, I don't see a big sort of another bout of depreciation. And over a period of 5 years, as you said, I think it will come back to the same old like 2-3% every year kind of depreciation scenario that can play out. And actually the good part versus Indian people sitting in India and those abroad, for them actually the market has become even more cheaper by say 6 to 8% because of the rupee depreciation versus what we are getting at. They will get it at even cheaper at 6 to 8% because of the depreciation. So I think it doesn't make any sense to sort of keep waiting. Beyond the point, one should not extrapolate the past 6 months or 12 months. The things eventually start reversing, or that trend starts changing at some point of time. And I think we had a sort of bad 1 year in terms of market return. We had a not so good returns from the rupee side of it. I think beyond that, we should not extrapolate bad things. And because the macro setup is not changing, the fiscal and current account deficit and the growth, these three things are pretty much same as which they were 1 year back as well. There is no change in this macro thing. So I think this is a good opportune time for particularly for the NRI investors to take the exposure.
Okay. And say normally when we talk about these exchange rates, we talk about the rupee dollar USD exchange rate. But say, as I said before a while, that the depreciation vis-a-vis the GBP is say 8%, euro 12%. So there the depreciation and the reasons I think could be a little different. So this scenario of this 2-3%, earlier it used to be 2-3% across different currencies, which used to hold true everywhere. But now it is a little different.
Yeah.
So do you think that that might continue on a country specific basis rather than the US dollar and Indian rupee kind of an equation?
I think there are a lot of sort of narratives or things going on in terms of de-dollarization and dollar starting to lose its sovereign kind of status, etc. Because some of the countries are wanting to trade in their own currencies. But I think for times to come, or maybe next 10-15 years, I think dollar can remain the de facto standard of trade for the global things. So after this short term of the different kind of depreciation versus currencies, I think ultimately all currencies will get or are pegged to dollar, and we will start evaluating against dollar only. I think there are a lot of questions or concerns about US economy. The debt they have piled up, like $37 trillion of debt is there, and presently the US government is not functioning. There is no funding for them. But despite that, I think US economy has a lot of plus points. Genuine innovation happens in US. So till that time, I think dollar will continue its supremacy, and once this uncertainties die down, I think people will again start pegging the currencies to dollar.
Okay.
Probably.
We call ourselves as people who are quite smart on evaluating investments and talking a lot about investments. But the fact what has happened in last 1 year, that the Indian housewives have been much smarter in terms of the decision making on investments rather than all of us. So do you think that this trend of gold and silver appreciating so phenomenally, or maybe not getting corrected, or that kind of a scenario, which is a bullish trend? Every day you got new highs which are coming up.
Yeah.
So that trend, you think that the same would continue in one way or another in the coming little time?
I think since the beginning, I've been answering to most of your questions, saying that probably we should look for reversal in the things which are happening in last 6 months, 12 months, or 3 years. Even in case of gold and silver, I think it's, very difficult, or nobody could value the gold because of the nature of the commodity. But I think if you study the long history of gold, gold has given returns in about of say 4 5 years, very good return, and then it goes in stagnation for 6 8 years. Whatever has happened in last 3 5 years is because of wars going on at 2 3 places, the currency wars and the US government debt, etc., etc. But I think now world as a whole, and even Trump administration, probably they will start to find solutions and reduce this uncertainty. And once that happen, I think the appreciation or the rise which is there in the gold and silver, I think that rise can stop, or at least may recede. The extent to which it has gone up in last 1 year, almost 50%, probably it can go up another maybe 10 15 20%, who knows. As I said, it's very difficult to value, but studying the long history of these asset classes and studying the responses of central banks and governments, I think when things or these governments or central banks push to a corner, solution starts coming out. And when the solutions come, obviously gold and silver, that rise can take a pause there. So I think one should not extrapolate last 3 years of gold and silver rally. Obviously, as I said, nobody can predict maybe when it will stop. So the right way to approach is basically have some maybe 15 20% kind of allocation out of the financial assets, because as you have mentioned rightly, that obviously Indian households already have exposure to gold through jewelry and maybe even other ways. On top of that, having increasing financial exposure beyond say 15 20%, after such kind of a robust performance, I think may not be very prudent. So I think somewhere one should start exercising caution. We have seen multiple times in equity market, particularly, that people chase returns of last 1 year, 3 year, and then it is not a good experience for those kind of people. It should not happen in this case as well, that looking at the past 3 year and returns or so, people chase these asset classes and then get stuck there for long term. So I think the key is asset allocation. Don't be greedy after such kind of rally, I think.
So as Nilesh Bhai Shah of your asset management company, he says that the central banks are now behaving like Indian housewives. So
Yeah.
in that kind of a situation, where that is a new factor which has added to the way the prices have been moving.
Correct.
Yeah.
Yeah.
So wherein the central banks in last 5 years, as we know, all the statistics have been
Yes.
saying that they have been collecting gold, or rather, they have been increasing their exposure to gold and reducing it to US government securities.
Yes.
And they are those kinds of investors, or rather people who have invested, who would not divest. So, in that kind of a scenario, is it not something where history of gold, doing good for some period of time and then remaining into a sideways for another maybe 5, 7 years, that might not repeat, and this could be a different kind of a scenario.
I mean, yeah, obviously, uh, nothing is sort of permanent in financial markets, etc. But I think obviously central banks may not divest the gold which they have accumulated over the years, but asset prices are determined at the incremental buying and selling. So even if central bank to stop or reduce their buying intensity, that itself can put a cap on the gold prices. It is not necessary that they start selling. Even if they stop buying incremental, I think in CY24, RBI made the record buying of gold, but in this 8 months, they have significantly reduced. So I think central bank also will sort of look to buy at a particular point. They were buying at maybe $2,500 or $3,000, but now it is, I mean, I'm talking about the per ounce price in dollar terms. But even at $4,000, whether the central banks will keep buying, that is the question one has to sort of think of over. I think at a they will also be a buyer at a price, and probably they may not keep chasing at these prices. So it again, I don't want to extrapolate things of last 2, 3 years. That's the point. I think even central bankers may not want to keep buying gold after it having more than doubled in last 3, 4 years. So the reduction in the buying intensity itself can bring a cap. They need not, obviously, and nobody sell gold, including central banks or household. Nobody sell gold. It's about the buying intensity, which makes a difference for the commodities.
True.
So you give a very good perspective starting from the impact of US on the economy, the way the Indian markets are from the viewpoint of valuations, earnings, and the flows,
Yeah.
and also about the commodities, the gold prices, the trajectory that you are looking at. Now we would like to know your perspective on the US market, because the entire world is now going, I would use the word crazy on AI.
Yes.
And that is what has led to the boom in the US market predominantly, because all the indices, all the stocks which have got some kind of a connection with AI have led to this kind of a rally. Now, at this point, at this valuation, at this level of the US market, how do you think it will go further from here? Will it also go through the reversal route that you mentioned for the other things, or you have a different perspective?
Yeah, there also I will maintain the sort of mean reversion kind of theory, which always plays out in sectors and economies and markets. So I think if you look at the 6, 7 stocks, the Magnificent Seven of US, they are continues to go up, and of late there is some kind of circular funding which is going on. Some companies investing into other company, and that company invest into third company, and everything goes up once they get the funding. I think those companies are committing huge amount of capex for data centers and power, etc. On the assumption that AI pickup will be substantial. But till now, I think the use case of AI or the productivity gains of AI are still to be established, at least for the businesses. We are using it like ChatGPT and Copilot and all, but the tangible benefits are yet to be seen from the AI. So if you read some articles written by uh, very knowledgeable people on the Wall Street, so people have started to doubt the AI exposures now, and some people have started calling it a AI bubble. And I think there also one thing to point out that all these tech stocks are extremely price sensitive or growth sensitive. Uh, so any good news and the stocks goes up 20-30%, and I'm sure when the news flow turns on the negative side, the reaction would be similar. They can come down significantly. So again, there I think one need to exercise lot of prudence. and particularly when there is so much of sort of overvaluation for the future growth, I think one need to be cautious in those kind of investment. It's better to lose the upside in such cases than to take that risk.
And just taking forward what Rajit said, that yes, the US markets are at the top. And every day, and before a while in our discussion also, you said very rightly that US is running a debt of 37 trillion US dollars. So every day we hear that, there are one thing or another which is not so good when it comes to economy, in terms of governance, in terms of action, so many things which we hear every day. And as we are very sure that the world at large is watching all these things. But still the paradox is that despite those negative news, and at times we feel that something which happens in, emerging markets, those kinds of actions are happening in the US. So despite all these things, the stock market is at the all-time high. So what explains that?
I think two things. One, obviously, few of the companies, like we mentioned, they are reporting or giving that hope of a very high rate of growth for coming years. So growth expectations are very high, and that is supporting the market. And second, obviously, is liquidity. So if you look at the history, ever since Lehman Brothers crisis, uh, the market has made a implicit assumption that if anything happens, the central bank will come to the rescue. And it has panned out in last 2 decades or so. So it started with Lehman Brothers, the federal government and the Federal Reserve and the US government came into action, and they saved 2-3 companies, and in 1 or 2 years it was taken care of. In 13, 14, 15, I think there were concerns on few countries in Europe going bankrupt. Pigs, they were called: Portugal, Italy, Greece, and Spain. And then European Central Bank said that we will do everything to take care of them. Mr. Mario Draghi was the governor that time. So market relied on his word and moved on. And it happened again in the COVID times. So when COVID struck, there was a huge money supply, or the printing presses work, I think, overnight to print money. So I think market has made an implied assumption that central bank and governments will come to a rescue if something to happen, something very bad to happen. And those things are, I think, keeping the market afloat. And so I think two things: one, growth expectations, and liquidity. These are the two things which are sort of helping the market float. And particularly in US, as you mentioned, probably the governance standards are even below the emerging markets, many emerging markets. So despite that, the markets are holding up.
And say, we have been talking of the AI and the tech kind of companies. So those are one set of companies which are basically those tech NASDAQ driven companies. So then the another set of companies in the US are the S&P 500 ones, which are more focused on the US and the companies which could benefit out of deglobalization. So are those companies could be somewhere where there is still a value, and those are the companies which could take the baton forward in terms of the US markets going further on?
Yeah, I think for the rest of the US market, again, there will be two kind of sort of buckets. One, which will obviously can benefit out of it. I think US banking system, etc., they are in the pink of health and doing very well. So if the US economy to start investing in their own manufacturing and all those things, obviously the services industries in US, particularly banks and others, they can do well. But in the meantime, many of the industries in US has to face the input inflation. So while they are imposing tariff, obviously it will get passed on to the consumers of US. And when they pass on, not everything can be passed on. For example, if retail chain like Walmart, obviously it procures almost 70% of its goods from the other countries, and they have to pass it on the tariffs to the US consumer, but they may not be able to pass on fully. So some margin hit they have to take. So those kind of companies, I think, over next 2-3 years can see margin compression and may not be able to report good growth. So I think it is a mix and match how those companies are able to deal with this inflation. At the same time, one more thing which is happening at the global scale is basically what's happening in China. So China has tried to stimulate their economy in last 5-10 years through a lot of demand side measures in terms of giving a lot of stimulus to the consumers. That didn't work out. So now they're looking to curb the supply side, reducing the capacities of the various sectors, and thereby reduce output and get the inflation back. So it is called as anti-involution. So that is also would be a inflation exporting thing. So for last 20-30 years, China exported deflation to the world by keep reducing the prices down. If this anti-involution plays out, globally there will be inflation in the commodities, and that will again hit the US consumer and US companies. So I think it's we cannot paint the entire non AI companies with one brush. Some will benefit and some will be at the receiving end because of these 2-3 things. So it will be interesting.
Dynamic, interesting
Yeah,
times to come.
interesting times.
Yeah. And in coming 3 years, according to you, beyond India, which could be the, say, top 3 economies to look at in terms of the economies which will grow very well?
So we discussed so many things about US and China, but I think the drivers of global growth will continue to be US, China, and India. I think rest of the world, I think, will be keep lagging, but these 3 countries or economies are the ones which will keep driving the global growth. So US through innovation, India through, I think, the vast scope for penetration and the aspirations, and China through their competence in terms of managing cost, etc. So I think these 3 will be the global growth engines. But it doesn't mean that those markets or the equity market of these all 3 countries will do well. That is a different story. But in the economic terms, I think US, China, and India are the obvious future for next few years.
And as you said, that economic terms, yes, those 3 markets. And now on the investment front, on the stock market front, is it a good idea? So what could be the good idea in investing into which all economies outside of India? So India, yes, as you rightly said, and we all believe, we are all believers of the India growth story. That's done. But beyond India, which could be the economies where an investor can take a certain level of exposure and diversify their investments?
I think, frankly speaking, at this point of time, I don't think it's worth to take overseas exposure, even from the diversification point of view. Because there are 2 main overseas market as we discuss economies, US, and we discuss about the sort of bubble theories which are some people have started predicting there. So I don't think there is a point in taking that kind of risk after the market having done so well and at this valuation. And the same holds true for China as well. So 1 year back, China was trading at 8-9 times P. After this 50-60% rally, China is trading at 14-15 P, which is their long-term sort of peakish kind of valuation. So I think in this scenario, then there is no sort of point or sense in chasing those markets. So better to look at, I think, Indian market, which has not performed. And apart from these 3 markets, I think no other market come to my mind in terms of investing or secular investing. There can be trading rallies or all those sort of things happening in Europe or Japan, etc. But otherwise, I think from a long-term perspective, US and India makes a lot of sense. But US has a problem of this bubble theories coming up in terms of AI companies or AI narrative. So it's better to be in India. We know what has happened here, and we know what sort of measures has been taken care by government and RBI. And we know that our macro is very strong. It is not like 15 years back kind of story. So then it makes a lot of sense to stay invested in India rather than looking for other opportunities.
Okay. And China, you don't see that there could be a complete re-rating on account of the way now in earlier times, as we all know, they were more focused on rather manufacturing and making for the world. But now they have their own technologies, and those technologies in last 5-6 months, the world at large has understood that they are at par, and in some cases even better than what US technologies are. So even they are working on being IP owners rather than manufacturers
Yeah.
on the basis of somebody else's IP.
Yes.
So in light of that, would China be a market which would be holding a different kind of valuations in the times to come, another 3-5 years?
Uh, I I don't see Chinese market getting re-rated on a secular basis. So the starting point is whatever said and done, what is happening in US, it is still a democracy. So if Trump policies doesn't work out, the people will take a decision to change the government, and then things will normalize. So democracy, having a vibrant democracy itself demands some kind of premium. And I think China, we can't say that there is a vibrant democracy. So that is the starting point. And we know what has happened with Alibaba and those kind of companies few years back. So things keep changing in China depending on the need of the parties and all those things. So I think that is one big hindering factor, that re-rating may not happen. Second, we spoke about the US government debt being a big problem. But in China, government is not indebted, but the private sector and the households of China are very, very highly indebted. So I think I can take the risk of US government debt, because US government is the US government in the end. So they will solve it somehow. But if the debt is in the household and the private corporate, like in China, I think if things go bad, it can be very bad. So that is second, that China is indebted on the private sector side. And third, we spoke about the technology. But all those, if you look at carefully, all those things which China has done in terms of technology, it is in EV or AI, etc. But nothing is like the first time invention. They bettered the US technology or bettered the US product, but the first time the product was made only in US. And till that continues, I think nobody can replace US.
Okay, interesting.
On that note, which you mentioned, that India is the place where we should be looking at to allocate the further investments for all the reasons that you rightly mentioned. What do you think could be the top sectors that will play out in India from your fund house perspective and also your individual thought process, whatever is going around?
Yeah, so if you look at particularly post-COVID, I think the sectoral leadership is changing very fast. The business cycles or market cycles are getting shorter because number of participants are going up in the market as well as in the businesses side. But having said that, so because of that, I think the sectoral preference will keep changing on a actively managed basis. But having said that, I think one or two segments which we are liking is one, basically private hospitals. I think that is the space which can continue the run in a secular way for next 10-15 years. And very similar to what has happened in the private banking space in last 20-25 years, the need gap was there, which was solved by private bankers, and they created wealth. Similarly, there is huge need for the healthcare services, and government hospitals or doctors may not be able to fulfill, but private hospital is the way to do that. And like we had good bankers, private bankers, I think we got a very good management on the private hospital side. So I think this is one segment I think can continue to do very well. I need not explain the opportunity and the need for the same. The second, which may be a next 2-3 years kind of story, is basically cement. We all know the huge amount of consolidation has happened in that sector, and the sector is not making a lot of money. Actually, the return ratios of the sectors are very, very pathetic. But because of this consolidation, I think the the companies can start exercising the pricing power sooner than later. And I think that can cause the sector to do very well in terms of profit growth as well as some kind of re-rating from here as well. So these two sectors comes to my mind. The one very contra or sort of tactical bet you can say, contrarian bet you can say, is basically IT investment. We spoke about AI and bubble there, but I think for the Indian service providers point of view, we have seen a down cycle of last 3 years. They did very well in 21 and 22 after COVID. The whole world thought that the world will only meet through Zoom and Teams and not like this. But things have changed. So last 3 years were a low cycle for them. And I think over a period of next 6-12 months, we can see the demand coming back. And even for AI to work, I think a lot of back-end work has to be done in terms of data or data structuring and all those things, which will eventually can come to Indian IT players. The valuations are in our favor with dividend yields of 3.5% for most of these companies. So IT is a contrarian bet, but I think long-term structural bet clearly is the private hospitals and to some extent cement.
Okay. So these are on the positive side.
Yeah.
Which are the sectors where you see that the valuations are very rich and they are set to go down in another little time to come, another couple of years?
I think in some of the segments, like many of the traditional FMCG companies or consumer companies, we know that the valuations are very on the very high side, but these companies are not able to report profit growth. In some cases, competition is going up. Looking at the margins and the return ratios, the big groups are entering into each other's segments, and that is causing loss of market share for the established player, and hence we are not getting profit growth. In some cases, I think the modes of brands and distribution for the traditional FMCG companies are getting eroded, and they are getting captured by this new age platforms or new delivery companies. So these new quick commerce companies or e-commerce companies, because of the size and scale they are getting, as well as the convenience factor which they have established in terms of delivering in 5 minutes or 1 hour, etc. I think they have started to exercise their pricing power versus customer in terms of charging delivery fees, platform fees, and all those things. On the other side, because of the scale which they have achieved, they are squeezing the suppliers as well. Also, because of these platforms as well as retail chains, it has become very easy to launch new brands and private labels, which is again causing the traditional FMCG companies or consumer companies. So I think this consumer basket which is there, because of competition, because of losing of modes and distribution modes or brand power, etc. I think if the profit growth remains muted like this, eventually they will derate. They may not correct in price, but already we have seen last 3-5 years no returns from these kind of stocks, and the situation can continue for long, and that will automatically cause derating of those stocks.
So FMCG is one sector.
FMCG as well as some of the consumer categories, like even we are seeing that in the paint it is happening, and it can happen in some of the other sort of related categories as well.
Okay. So we have talked a lot about Indian stock market, listed space valuations, the US stock valuations and everything. Now, lastly, I would like to ask one question about the valuation of private equity. The reason why I'm asking is that the way private equity are valued, then ultimately the final offload is through the IPO route and they get listed on the stock exchanges.
Yeah.
So we have seen in last little time that there have been certain companies which are marquee companies, but then they have listed on the stock exchange at a discount. So what would be your perspective on the valuations in the private equity space?
I think in the private equity space, or I would say unlisted shares, it is very difficult for the retail investors to sort of come to a right conclusion in terms of how to value those unlisted companies, because in some cases always there is other factors which are sort of impacting the behavior in terms of buying and selling, and one basically till now which has worked is FOMO, fear of missing out. I think people bought many of those unlisted shares uh, out of fear of missing out the next big thing, and they got stuck. I think when companies list to the market, they come out with, they have to share a lot of information in terms of financials and risk factors and all those things, and basis that the public market values them. And there we got a lot of negative surprises when they come to the market in terms of valuation. So I think for a retail investor to indulge in unlisted space, I think is always full of sort of risk. It is better left to the actual private equity investors, etc., because they can assume those kind of risk, and they also have the research sources and the professionals to value those companies, which the retail investor may or may not have. So I think it's better not to indulge into those kind of things. Rather than the fear of missing out, I think it's better to focus on what we have in the public markets.
So, say there is a maybe AIF, which is a category 2 AIF, wherein there is a structured route. So, there the valuations which we look at, is it something where that market, which is the private market, uh, how is the kind of valuation which is being looked at? When it comes to the listed space, yes, there is a certain level of a certain thumb rule in terms of PE, PB, and all those parameters which we look at basically. Then we extrapolate and we build up a scenario. But when it comes to these kinds of private investments, uh, are the valuations which are being looked at, maybe even for platform companies, for IT companies, or maybe brick and mortar companies, they are something where you think that they are in a level which is in sync with the valuation norms?
I think so in the market, a lot of IPOs happening or unlisted shares are there. In many of those are new business models or new age sort of companies, where often comparables are not there, and in many cases those companies are not even profit making, or cash flow generation doesn't exist in many of those companies, and it is always very difficult to value those companies. So if it is done in a structured manner in a AIF or some kind of vehicle where the professionals are taking that call of buying the unlisted share, I think to some extent we can look at those kind of vehicles or structure. But the earlier answer I was giving to directly retail investor buying into unlisted stocks,
Right.
I think that should be avoided. Even in the other the AIF space where the investment can happen in unlisted by professionals, I think it is a risk. It is a game of, I think, probabilities. In maybe out of 10 investment, 2-3 may not work, and then but the others will cover up for the losses in the 2-3. I think that is the way private equity or venture capital space works, and it probably to some extent it can hold true for the unlisted space AIF as well, where they will invest in 10 companies and 2 may not or may not come to the IPO stage. So we have seen many private equity investor marking down these valuations substantially in subsequent funding rounds for those companies. So I think the risk, that space is full of risk. Obviously opportunities will also be there, but it is full of risk and may or may not be right for the common public. It may be good for institutional investors or ultra high net worth individuals or family offices, etc. But for a common public, I think I don't, see as a very right kind of investment opportunity, because it will be full of risk and the outcomes can be binary to some extent.
Okay. Lot of insights and a lot of information, and maybe a complete 360-degree perspective
Thank you.
on
Those are big
India
questions. Thank
and
you.
the global scenario and everything. So nice of you sparing your valuable time. And thank you so much. Thank you.
Thanks
Thank you.
for
Thank you
Thank
so
you.
much.
Thanks for joining. Thank you.
Thank you.